Hey everyone, it's Sam Does Stocks here, and today I wanted to talk about why I think defense stocks are a great sector to invest in right now. So, just want to start off with the fact that these stocks are quite cheap for the most part. They either follow market multiples or they're slightly below them. And if we look here, we've got quite a few options to select from. So, obviously, I think it goes without saying, Boeing is one that you don't want to touch right now. I know you hear the classic phrase, buy when others are fearful and sell when others are greedy. However, in Boeing's case, I still think it would be a good idea to not touch the stock, given all the regulatory issues that they're having, given the recent miss that they had with NASA, given their giving their contract to SpaceX. I think there's going to be a lot of pressure on that business moving forward, especially with the way they treat their employees. I don't know about you guys, but for me, I want to invest in companies that actually treat their employees well, or at the very least pay them a lot to be treated unfairly. Let's put it that way. Mainly referring to JP Morgan and Meta here, in my opinion, of course. But looking here, I would say, in my opinion, the best stock up here is probably Northrop Grumman. Now, there's one that's not on here that I'm going to talk about later that I think has a lot of great potential behind it. But Northrop Grumman is fantastic. Lockheed Martin is also a no-brainer. Everything on this list definitely has its pros and its cons. Now, I was looking through some of the forward PEs for these companies, and I just realized that if you were to park your money in these stocks, very, very, very cheap. You're not paying an expensive price for these stocks. I mean, if you look at Northrop Grumman's forward PE, it's a 20.44. Not bad at all. If we were to look at Lockheed Martin's, I want to say it's around the same. Yeah, Lockheed Martin's is around the same. It's a 21.69, so a little off of Northrop Grumman's, but still very, very good. And I mean, when you look at that, you got to say to yourself, okay, I'm paying a fair price for this stock. And when you're paying, let's put it this way, when you're paying a fair price for a high quality company, you really don't have an excuse not to buy it. Now, one that I'm quite interested in is called Oshkosh Corp. Now, Oshkosh Corp, based in Wisconsin, my home state, so that's a win there, of course. But forward PE wise, they're very, very, very cheap. I mean, if you look at that, that is a 9.4 4P. That's extremely cheap, especially compared to their competitors. And the thing I like about Oshkosh Group is if you look at their stock, very not only do you have a very cheap PE ratio, but you've got a great dividend to pair with that, and you've got a smaller market cap. So a smaller market cap can be a boon and a negative at the same time. It can be a boon in the sense that if people put their money into it, it doesn't take a lot to move the needle. But in that same sense, that also might scare off bigger investors from buying up the stock because it moves the needle too much. So, for example, are you going to see a Warren Buffett sized hedge fund like Berkshire Hathaway buying this? Probably not, only because the market cap is too small. But give it time, and then you can really start to see an acceleration there. And it looks like year to date, not having the best returns. However, when you're trading at a multiple like that, especially in a market like this where a lot of stocks tend to actually be overvalued, I have no doubt a stock like this would probably, take some traction. So looking at it too, I've not actually had the chance to look at this, but I do want to see what their metrics look like. Because if I look at the metrics and all of a sudden they're negative or they're not great, then that kind of changes my perspective on things. So it looks like the only data we have goes back to 2021, so we don't have a lot. It does look like though things are trending positively. I would probably attribute this negative dip in 2022 to just general market pressures, of course. Let's see what Oshkosh's revenue growth looks like. I would imagine that's probably decent, especially given that Oshkosh. The big thing with Oshkosh, before I even forget to mention it, they've got that USPS van deal that they took from Workhorse, and of course, a lot of those meme investors were disappointed that Workhorse didn't get it. But quite honestly, it's not a surprise given that a company like Oshkosh very well built out, lots of, pre-established moving parts to take care of the USPS deal, whereas Workhorse, brand new company, not a lot to show for it. So it honestly does make sense that that happened. We can see what their revenue growth looks like. By the way, if you want to look at these things, always use Macro Trends. Macro Trends is a fantastic website. I love to use it. It gives a great kind of basis for what a stock does. Okay, so you can see here, really, really strong revenue growth. And again, you have to factor in that this USPS deal is probably driving quite a bit of it, but that's still quite good. So honestly, out of all the defense stocks I've looked at, recently, that one is probably the best. That, Northrop Grumman, or Lockheed Martin, in my opinion, are the ones you should go for. So some of the bullish factors, and again, these aren't positives because look, I'm anti-war. I think most people probably should be, but these are just blunt realities of the world we live in. We have a future potential conflict with Taiwan that could occur, and we have a current ongoing conflict with Ukraine. And the blunt honest truth, regardless of how you feel about it politically, is that these countries will continue to be funded for defense purposes. The U.S. government likes to defend its allies, even if it costs a lot of money. So you're going to see Taiwan continue to get extravagant funding. You're going to continue to see Ukraine get extremely extravagant funding with what they've already got. And the windfall from that for these defense companies is massive. It's massive. I mean, if we look, U.S. military spending just has gone up every single year. We started at 1960, 47 billion to today, 87 billion. That is a significant increase. And funnily enough, you can actually see the percentile returns at the bottom going down for the most part. That will probably continue to remain flat, but the actual dollar amount is extremely high, right? Like you can have from 1960 to 1961, you can have about a 9% increase. That amounts to about $2 billion. But then a 3% increase from 2021 to 2022 is about $70 billion. So I wouldn't really pay attention to the percent metrics. I would more so pay attention to the actual dollar amount because that windfall, again, for these defense companies is incredible. And look, we all know that the U.S. government does not spend its money as efficiently as it should. That's just a blunt truth, regardless of how you feel politically. Looking at it now, when you have $8 trillion of money that goes towards wars, that obviously not all of that's going to the defense industry, but when you have such a large financial interest, you have to think that these companies get some significant benefit from it. And if we look at these companies' returns over the past, couple of years, especially with all the conflicts we've had, they've been quite good. I mean, let's take a look at Oshkosh, like we were just talking about. 5-year return, 53%, solid. But then you look at it in the grand scheme of things, definitely decent. If we look at Lockheed Martin stock, 5-year return, 47%, decent, not great. But then you look in the grand scheme of things, a lot better than it's been. So I feel like these windfalls will continue to be immensely positive for the defense industry. And no matter how you feel about it morally, a lot of investors are just going to look at it purely from a numbers standpoint when determining their decisions. And I have no doubt that these companies will continue to have some solid growth and some solid fundamental changes that, work in their favor. Obviously, like I said, probably should avoid Boeing, especially when they're having, just ridiculously bad earnings. I mean, they're in the negative this most recent quarter. And they've also just had trouble, getting back to their pre-COVID highs. So that says a lot. But all in all, defense industry pretty dang solid. I would definitely look into it. And if you morally don't feel like it's the right industry to be in, nothing against you. I'm anti-war myself, but I still see the value in these stocks because at the end of the day, the reason the US puts so this is not talked about enough. The reason the US spends so much money on wars and the reason the US spends so much money on military funding is to stay ahead technologically. If you have technologically advanced military weapons and equipment, that is a major deterrent to other countries attacking you. That's why the US spends so much because we can flex our muscle in a sense to make sure that other countries don't attack us or don't feel they have the manpower or the technological prowess to. That's why you hear the phrase paper tiger thrown around with China. It's because at the end of the day, people realize that China has a bunch of bark but no bite, and that's the truth. That's why this image right here probably a good representation of them. But yeah, folks, that's what I wanted to talk about it today. These were my brief, unedited thoughts on defense stocks and kind of the factors that loop into them. I could do a much more extensive video, but I want to keep it short for you folks. If you enjoyed today's video, don't hesitate to leave a like, subscribe if you enjoyed it, and if you didn't enjoy it, feel free to leave a thumbs down, leave a comment as to why, and I'm more than happy to discuss it in the comments. Have a great day, folks.